Global markets are quiet with the US on Thanksgiving holiday. Data centres in Australia underpin an investment jump, putting further pressure on the RBA to hold rates. And the Bank of Korea holds rates. That's coming up in our 5 Things in 5 Minutes on Friday, November the 28th. And then in our deep dive interview, ANZ's New Zealand business outlook hit its highest point in a decade, something ANZ New Zealand chief economist Sharon Zollner says shows the economy has turned.
The market at least could flip from talking about the timing of the last cut to the timing of the first hike rather quickly.
But first in 5 and 5 with ANZ. Overnight, the US markets were closed for Thanksgiving, so the focus was on Europe, where the European Central Bank released minutes of its last hold decision. ANZ economist Henry Russell says the ECB remains open to further easing, which it needs to do given Europe's subdued lending recovery and a yet-to-appear fiscal stimulus.
We've long held the view the ECB will need to retain an easing bias and that the easing cycle may not be over, with inflation set to undershoot the target from next year and into 2027. The risks are tilting towards that undershoot becoming more persistent, meaning it is appropriate for the ECB to adjust interest rates lower to underpin the recovery.
So with those US markets closed, as of 4 a.m. Sydney-Melbourne time, West Texas oil futures rose 0.4% to $58.85 US a barrel. Gold fell 0.3% to $4,189 US an ounce. The US dollar index was flat. The Aussie dollar rose 0.2% to 65.31 US cents. And the Kiwi was up 0.3% at 57.23 US cents. Number 2. The UK autumn budget yesterday saw pre-announcement market moves as the forecasts were accidentally released before the Chancellor parliamentary speech. But as ANZ FX strategist Preksha Jain explains, markets were soon calmed by the fiscal room opened up through tax increases.
The OBR forecast set out higher than expected fiscal headroom, around £22 billion, and this pushed the UK gilt yields lower by 3 to 5 basis points across the curve. We saw immediate reaction in FX markets as well. The sterling started to move higher against the dollar towards its monthly high. This upside came with high volumes as well, as the GBP December future contract saw highest volume in a week just after the OBR release.
Number 3. Australian private capex investment leapt 6.4% in the third quarter, well above market expectations for 0.5%. ANZ senior economist Adelaide Timbrell says data centre investment drove the strength.
The information media and communications capex rose by 40.7% in the quarter and contributed just shy of half of the total growth in non-mining capital expenditure. We also saw a big jump of capital expenditure plans outside of mining, up 12.1% in the quarter or 10% versus last year. The stronger investment polls alongside the latest monthly CPI, which are trimmed to mean at 3.3% for October, may increase the hurdle for the Reserve Bank to cut rates further this cycle.
Number 4. The Bank of Korea held its benchmark rate at 2.5% yesterday as expected, as worries around the housing market and currency volatility persisted. ANZ chief economist for Southeast Asia and India, Sanjay Mathur, says there was a fall in the number of policymakers open to a rate cut in the next 3 months to just 3.
This compares with 4 in the previous meetings. So currently we have one more rate cut penciled in for early 2026, but we will monitor growth dynamics carefully to decide whether it is needed at all.
Number 5. Retail sales in New Zealand rose by 1.9% in the third quarter, stronger than expectations. ANZ senior economist Matt Galt says that presents more upside risk to ANZ researchers' forecast for GDP to rise 0.5% in the September quarter.
Looking at the details of retail trade, the growth in volumes was actually quite narrowly concentrated in electronics and vehicles, which poses a bit of a risk to ongoing momentum. But overall, given the strength of the increase in sales, along with the fact that it was quite broad-based across regions, suggests that this was still quite a solid print and shows consumer spending increasing in New Zealand.
Matt Galt there. Now, in our deep dive interview, ANZ New Zealand chief economist Sharon Zollner talks through the results of the Business Outlook survey for November, which has confirmed the economy is on the turn.
It was great to see in November a solid lift in both business confidence and firms' expectations for their own activity. Both of them are the highest in more than a decade. And what's perhaps most encouraging about the results is that it seems to have come about because firms are experiencing an increase in activity already now. So when we ask firms how the last month has gone compared to a year previous, there's now a net 21% of firms saying that it's higher, up from +5. And that's the highest read since August August 2021. Now, importantly, you've got to bear in mind that the point they are comparing to was very, very soft. A year ago, the economy was basically just starting to come out of recession. So it's certainly not suggesting that growth rates are about to return to 2021 levels anytime soon, but it does perhaps provide some encouragement and reason to think that these green shoots are going to thrive because something is actually happening. It's not just optimism, people thinking, the Reserve Bank cut rates 50 points in last month, so therefore something must happen, but actually rather that firms can see something happening.
Is the optimism broad-based or is it still concentrated in certain areas?
The biggest increase in confidence was across manufacturing, actually. That was a clear leader in terms of which sector saw the biggest increase this month across a whole range of questions. So manufacturing in New Zealand can be broadly divided into that which is to do with food production and that which is to do with construction. There are other firms as well, but those are the big two components. So the agri sector has been doing very, very well for quite a long time. So one suspects that the mover is construction and construction materials. And indeed, we did see a jump in residential construction intentions of 10 points to the net 46% of firms in that sector saying they are expecting stronger construction activity. And commercials at very similarly well. That's the highest since 2014. So I think that perhaps explains why the manufacturing sector was the big outlier this month. But basically we saw a lift across pretty much the whole economy, I would say. Agriculture has been dancing to its own tune for a while. It's been very strong while the rest of the economy has been weak. But even there, we saw a lift in past activity over the last month.
And what are you seeing in the inflation indicators for the Reserve Bank to keep an eye on?
So as the economy starts to recover, it is going to, unfortunately, be very important to keep an eye on indicators of inflation. The Reserve Bank described the inflation outlook as balanced when they cut rates. They saw they saw upside and downside risk around the economic recovery that could be stronger or weaker than expected, but also a risk that we've identified, which is that firms' margins have been very squeezed through this slowdown. It's become very, very difficult to pass costs through into prices. And the question is, how many firms think their margins essentially are unsustainable and are waiting to raise their prices as soon as demand is robust enough to handle it? So that is definitely an upside risk to inflation were that to happen very quickly. We saw pricing intentions lift in the month in terms of the net percentage of firms who are intending to raise their prices, but it's still within recent ranges. And the proportion of firms who are expecting higher costs actually dipped slightly, and inflation expectations were flat as a pancake and very well behaved. So at the moment, you'd have to say all good, but I think it is going to be something to keep an eye on. But basically, the economy is now in an uptrend in terms of the business cycle, but there's a lot of uncertainty around what trend we are cycling around. And the Reserve Bank actually said that they think that the speed limit of the economy is a measly 1.5% at the moment, which means that the market at least could flip from talking about the timing of the last cut to the timing of the first hike rather quickly. But we're not anticipating hikes until 2027 at this stage.
And what were firms saying about employment intentions? Are there green shoots there too?
So the labour market does typically lag the broader economy, but we did see a lift in employment intentions as well, up from 15 to 18.5. And similarly to activity, there was an increase in reported actual employment already, even though we consider we're quite early in the recovery. It's still negative though, -2. So still a net 2% of firms saying they've got fewer staff than a year ago, but that's well up from -10 the previous month and suggests that annual employment growth is going to tick up into the positives before long.
Sharon Zollner there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, November the 28th. Catch you next week with a look at the latest Australian private sector credit data. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.